Okay, students, we're on chapter 11 now, which will be the last chapter we cover this semester. Chapter 11 deals with stockholders' equity. And so the word stockholders suggests we're talking about corporations. So we're going to be dealing specifically with the types of transactions involving corporations and their stockholders. Now, the concepts we're talking about generally apply to other forms of business, to sole proprietorships, partnerships, limited liability companies or LLCs, and limited liability partnerships or LLPs. But the accounts are different, the laws are different, some of the specifics are different. So we are specifically talking about corporations here and their form of ownership. So right there you have the learning objectives. I'm not going to talk about those. And we move here through the introduction to the chapter and get down here to understanding the business. So in the corporate form of business. While corporations account for a relatively small number of businesses, corporations account for about 90% of total sales reported by U.S. businesses. Now, you think about the very large businesses like Walmart or Target, Home Depot, big companies like that are corporations. So it would take oftentimes thousands of small sole proprietorships or partnerships to account for the sales of one of those giant corporations. Now, they ask the question here, what makes the corporate form so popular? And one of the things is the owners their liability is limited to their investment. So if I own stock in a corporation and it goes bankrupt, I'm not liable for any of the corporation's debts. All I can lose is the money I have invested. So corporations can also raise large amounts of money by selling stock. Okay, some of the other things they talk about here, shares of stock can be purchased in small amounts. So if, for example, I decide I want to own some of Microsoft, then I can go out and buy Microsoft stock. And Microsoft's a stock I pay attention to. It's selling right now for about $176 a share. So in order to own 100 shares of Microsoft stock, which is called a round lot, round lots are lots of 100 shares. All it takes is about $18,000 and I can own 100 shares. So for a huge corporation like that, that's attractive to a lot of investors. Now, ownership shares are transferable. So if I buy some stock and then I become disillusioned with that company, or I decide I want to buy a different company, then what do? I just sell my shares. I can transfer them to someone else. Stockholders are not liable for the corporation's debts. I talked about that a minute ago. Now, the law recognizes a corporation as a separate legal entity, separate from its owners. What does that mean? It means corporations have most of the same rights you and I have. Other than the right to vote, corporations have most of the rights that we think of we have, things like being able to own assets, being able to incur debt, go out and borrow money, corporations can expand and contract in size at will. They can be sued by people and they can file lawsuits. They can enter into contracts independent of the owners. So they are separate legal entities, separate and distinct from their owners. Now, corporations are incorporated in a particular state under state law, not under federal law. That's pointed out in here. In fact, they point out that Delaware is the most popular state for corporations to be incorporated in. Now, in case that sounds crazy, little Delaware, how is it home to more corporations than any other state? Well, the answer is, and they talk about it right here, that Delaware has some of the most favorable laws for establishing corporations. So that's the reason. Now, they talk a little bit about the most basic form of ownership of a corporation is what's called common stock. And it's called common stock because what does the word common mean? It means plain or ordinary. It's just ordinary stock that conveys ownership. Some of the rights or benefits of common stock are, number one, voting rights. They have the right to vote on major decisions as stockholders, things like hiring the board of directors. Quite often, directors recommend and then the stockholders vote on dividends. So stockholders receive a share of the dividends. They may even get to vote on them. It's kind of like being able to vote on your own pay raise. Then, excuse me there, I had to cough. Next key there is the residual claim of stockholders. And residual means what's left, and that's the claim that stockholders have on the assets of the business. Their claim is secondary to the claim of creditors. So if money has been borrowed or things have been purchased on credit, then money is owed to creditors. They have a primary claim on assets. After their primary claim has been satisfied, if the assets of the corporation are sold and the proceeds are distributed, then creditors get paid first, and then any money that's left over, the residual claim is to the stockholders. Now, the preemptive right means if I own a share of a corporation, I have the right to not have my ownership percentage diluted. So if the corporation issues more stock, preemptive rights give me the right to buy my fair share of that. If I own 10% of the corporation, they issue stock, I can buy 10% of the stock and keep my ownership stake at 10%. Okay, equity versus debt. Equity is selling stock. Debt is borrowing money. So what's the difference between selling stock or borrowing money from a financing standpoint? Well, there are certain advantages and disadvantages of each. So we'll talk about those down here. Now, if you raise money through selling equity, that equity doesn't have to be repaid. In other words, stock does not come due for repayment at some point in the future. If I buy a stock in a corporation, the corporation is not obligated to at some future point buy that stock back from me. So if I loan money to a corporation, then there is a due date when they are obligated to pay me back. Now, at that point, they either have to repay the debt or refinance it, work out a new financing arrangement. So stock does not have that obligation. So in tough economic times like we're going through right now, if a business is financed through equity financing, they don't have notes coming due that they have to pay back on that equity financing. Now, second thing, dividends are optional. You're not obligated to pay dividends to the owners if you're a corporation. But if you have borrowed money, you are probably obligated to make periodic payments on the interest. Of those interest payments come due whether you had a good year or a bad year. So an advantage of the equity financing is if you're having a bad year, you don't have to pay dividends. Whereas if you had borrowed the money, you would have to pay interest. Now, obviously, there are some advantages for debt financing, and you see two of them here. One is if we have equity financing and we pay dividends, those dividends are a distribution of net income. They're not a factor in determining net income. Now, what that means is that they're not tax deductible. So a business pays dividends, then they've been taxed on those earnings, and then they just distribute it after they've paid taxes on it. Now, if you're an investor and you get those dividends, well, guess what? You get taxed on those dividends you receive. But that's a little bit different matter. That's what's referred to as double taxation of dividends. But right here we see if we, instead of financing through equity, we finance through debt and we pay interest, the interest is tax deductible. Again, dividends on stock are not tax deductible. And then debt doesn't change the stockholder control. In other words, if I own 10% of a corporation and they go out and borrow money, I still own 10%. If they go out and sell more stock, now I may own less than 10%. Okay, we move on down here and see this, all transactions between a company and its stockholders affect the company's balance sheet accounts only. Now, obviously, that means transactions between a company and its stockholders as stockholders. In other words, if I own stock in Walmart and I go down and I buy something from Walmart, then they're going to debit cash, credit sales revenue. Well, I'm not buying it as a stockholder, I'm buying it as a customer. So that transaction does not count. That's not between Walmart and me as a stockholder, it's between Walmart and me as a customer. Now, on the other hand, if they pay me a dividend, that affects only balance sheet accounts. They pay me a dividend. What is Walmart going to do? They're going to credit cash because they paid out cash. They're going to debit retained earnings because now some of those returning earnings are no longer kept within the company or retained. They are now being distributed. And so they have to reduce retained earnings because there are fewer earnings being retained in the business. Now, down here we get into some of the common stock transactions that we'll get involved in. And I only have about a minute and a half before this is going to stop on me. So this is a good point to stop. I'll stop here and pick up with these common stock transactions on the next video.